Good afternoon and welcome all to the 2022 tax update, where we'll be making sense of the changing tax laws. We will start the webinar with those tax changes which have recently been promulgated per the Tax Laws Amendment Bill, and followed by some of the important tax administrations found in the Tax Administration Laws Amendment Bill. These acts were recently signed into law by the President on the 14th of January, and a gazette was sent out on the 19th of January. I will then look at those tax changes and proposals that were presented to the nation in the budget speech that was held last week by our Finance Minister. This should give us a good enough idea of what to expect in the coming year. And lastly, I'll end off with a bit of questions from the audience. This slide should be quite familiar to those who have actually attended our tax updates in the previous years. For those who are not too familiar, I would like to just take a step back before going into deep with the tax amendments and proposals, and just look at the legislation cycle and set the scene a bit for those who are not too familiar with it. So in February of each year, we obviously see the budget speech and certain publications that come out in the year. In particular, we see the draft rates and monetary bill as supporting information to those budget proposals. The details of the proposed tax changes, such as the changes to the personal income tax rates, the tax rebates, thresholds, your medical aid scheme credits, and your excise duty, are noted in this bill. These tax changes usually need to take effect immediately or from the 1st of March. Therefore, this bill is quite an important piece of legislation which needs to be released quite quickly soon after the budget. Then we saw an anomaly that appeared and popped up in the last tax cycle in April last year, where we saw the Disaster Management Tax Relief Bill was introduced by the previous Minister of Finance, Mr. Tito Mboweni, together with the special adjustment budget which was held in June of 2020. This bill basically provided tax relief in respect to the COVID-19 pandemic. In recent news, however, and per a published gazette, the national state of disaster on COVID-19 was recently extended to the 15th of February of this year, thus still making this bill quite relevant. Then, in June and July of each year, we see the publications of the ordinary bills, which are the Tax Laws Amendment Bill as well as the Tax Administration Law Amendment Bill. Colloquially, we refer these bills as the TLAB and the TALAB. These bills contain more complex technical anti-avoidance legislative changes, as well as any emergency tax measures that may have been announced by the Minister in his budget. Due to the wording and somewhat vague connotation in the budget, we normally have to wait a couple of months until we get more details and some insight into these tax proposals. This is why these bills are robustly commented on after consultation between industry members. Then in October, we are able to consult with National Treasury via various workshops and public hearings. National Treasury consults widely with industry members from ASISA and BASA. This is where we have an opportunity to actually interrogate National Treasury on some of those pressing tax amendments that have come through in the bill, and really get to ask them those deep and inner questions in terms of the intentions behind some of these policies. Once consultation is concluded, we see the publications of a response document, a draft response document that basically summarizes all our questions and comments posed during consultation with National Treasury. This document basically sums up all the reasons behind the policy, the proposed changes, and the outcome expected. It also points out to National Treasury some of the unintended consequences of these proposals that National Treasury is not practically quite aware of. We then see a tweak of the bills before finalization over the October-December periods. Then in November, the medium-term budget policy statement is presented. The statement highlights the key government priorities, the size of the spending envelope for the next medium-term expenditure framework, and the proposed division of revenue and government allocation. And from here onwards, many tend to start speculating as to what we want to see or what's to come in the next budget. Then we finalize off in December and January with the final response document, which gets released and is an update of the draft response document, which was previously presented by National Treasury in October. Bills are then revised before it gets tabled in Parliament. The legislative cycle process is then concluded with the promulgation of these bills into acts. As you can see, this legislative cycle is quite a robust, interactive, jam-packed cycle with public commentary, and this is basically where Allan Gray, along with industry members, get to lobby certain tax proposals and around the practicalities and the tax technicalities for our clients. I'm now going to talk about some of the tax amendments that came through in the 2021 Tax Laws Amendment Act. And I'm going to first start off with the most common amendment, being the introduction to the Sars fixed tax rates for certain living annuity clients. This amendment is aimed at individual taxpayers with more than one stream of remuneration, who might have to pay additional income tax at the end of the tax year on consolidated income, even though there were separate remuneration streams which were subject to monthly PAYE withholdings tax. Currently, the PAYE system allows for taxpayers to actually voluntarily request additional PAYE to be withheld in order to buffer for that additional income additional income tax on assessment. However, like most of us, nobody would actually voluntarily opt to pay in higher tax if we're not compelled to do so, thus resulting in unexpected and unexplained tax debt for the pensioners at year end. National Treasury have intervened to circumvent this by preventing the additional tax burden and introducing these fixed rates to be applied. The tax proposal was initially anticipated to come into effect in 2021. However, due to the practical difficulties and after robust industry consultation, this tax change came into effect from 1 March of this year. The amendment enables SARS to instruct administrators to withhold a fixed rate of tax for certain living annuity clients, without us having to actually apply any tax rebates. Essentially, this change allows for SARS to determine the effective rate of tax in respect of the combined employment and pension sources of income per taxpayer, with reference to the latest data available to SARS. Just a brief update in terms of where Allan Gray is at the moment. We have received the tax directive letter from SARS and the bulk directive list on the 10th of Feb. Roughly 1/3 of our LA books appear on this listing, so that basically approximates to about 17,000 clients being affected by this change. The fixed rates are expected to be updated by SARS in early March. So basically by this month we expect to have an updated rate due to last week's budget proposals and changes on the tax tables and rebates. We will then apply these updated fixed rates only from 1 April to the applicable annuities. SARS in respect to a particular pensioner. The retirement fund administrators will apply the normal withholding tax rates per the normal tax tables. We have sent an interim communication to all IFAs last week, Thursday on the 24th of February, notifying them of this expected change, and that we will definitely communicate updates on the fixed rates along with the opt-out forms, which will only apply from April going forward. Just to note, the opt-outs can occur at any point throughout the year, and with circumstances of taxpayers changing, most likely most circumstances do change over the year, clients do have the option to opt out. I just also would like to highlight that clients are still able to elect their own voluntary higher tax rate if they do feel that the fixed rate is not a proper reflection of the rate that they would expect for the coming year. What's important to note is that the reduced rate tax directives, such as your DTA, so your double tax agreement directives and your hardship directives, will definitely supersede these fixed rate directives issued by SARS. We are currently planning on creating a detailed insights piece, which we anticipate for distribution by end of this month into early April. The next tax amendment that I would like to talk about is the provision for increased flexibility at retirement by allowing a retirement fund member to purchase a combination of annuity types at retirement. This amendment maximizes the retirement capital available to provide for an annuity. So before the 1st of March of this year, members retiring from retirement funds could take up to a third in cash unless that retirement interest did not exceed 247,500 Rand. And the remainder must be used to purchase annuity. And the purchase of this annuity could have been provided in one of three ways, namely via fund provided, which means that it's paid directly by a retirement fund to the member, or via fund owned. This means purchased from an SA insurer in the name of the fund, or thirdly, member owned, which means purchased from an SA insurer in the name of the member. Members could not acquire a combination of multiple types of annuities at retirement. From 1 March this month, basically from this month, a couple days ago, members of the retirement fund who opt to receive an annuity can purchase a combination of the three types of annuities I just mentioned. Therefore, a member can basically purchase a combination of a living and a guaranteed annuity. Where more than one annuity policy is purchased, a minimum purchase amount of 165,000 Rand per policy applies to curb abuse of the 125,000 Rand living annuity commutation threshold. This will have an impact on staggered transfers and retirement minimums, which have been increased by OPS from 150,000 to 250,000. This is in line with the 165,000 per policy minimum introduced. The next tax proposal is relating to the deemed disposal of retirement fund assets on cessation of South African tax residency. Now, this proposal created a lot of hype in industry and amongst a lot of retirement fund members. Just to give you a brief recap of what happened in the last tax cycle, the government proposed the introduction of Section 9HC in respect of when a member stopped being a South African tax resident. Their retirement fund benefit would form part of the assets that will be subject to a retirement withdrawal tax. This was where the member would have been deemed to have withdrawn from the fund on the day before their South African tax residency ended. The proposal was expected to come into effect of 1st March this year. The drafting of the section was inadequate and did not give effect to the intention of the explanatory memorandum. The proposal then ended up being withdrawn from the TLAB 2021, which was announced in November last year. And this withdrawal was in response to the submissions and concerns raised by both us and other industry members during extensive consultation with National Treasury over the tax bills. The main concern was that the amendment would result in tax treaty overrides, as the proposal was not in the spirit of abiding with international taxing laws. In order to address the complexities raised through the comment cycle, including the concerns that the amendment would result in double tax treaty override, government will start their negotiations on the effective treaties this year. I now want to draw your attention to the new penalty tax regime, which was updated and came through in the Amendment to the Tax Administrative Laws Act, which was published in the Government Gazette in October. In line with the South African Revenue Authority's strategic objective of making non-compliance hard and very costly for taxpayers, Sars basically says that it's your legal obligation to file a tax return. And obviously, if you're required to do so, it is your prerogative in terms of that obligation to file that tax return. This penalty regime basically helps to create a culture of voluntary compliance. It was therefore imperative that SARS enhance its ability to impose administrative penalties in a more responsive manner. The initial effective date was actually 1 December of last year, but due to SARS extending the 2021 filing season deadline for non-provisional individual taxpayers to the 2nd of December, a consequential amendment to the date on which the new penalty tax regime would come into effect got extended to 1 January of this year. SARS has been empowered to levy a late submission of return penalty where one or more personal income tax returns are outstanding. This means that if you file your 2021 tax return after the stated deadline, SARS will levy an administrative penalty. Just for those of you that have not realized, for individuals, we have passed the deadline on our 2021 tax returns. Prior to 1 December 2021, SARS could only levy a late submission of return penalty where there were 2 or more outstanding tax returns. As a transitional measure to this older rule, SARS will still apply this older rule for years of assessment from 1 March 2006 up until the 29th of February 2020. Right, so let's now move on to the good part. As I noted at the beginning, I will take you through those tax amendments and proposals outlined in the budget, which are noteworthy and of relevance to your clients. Hopefully, after the session, you will be able to engage with your clients on a more robust level and share our views as well as those of industry on the key takeaways of the budget. Before we start looking at the key tax proposals and changes, I always feel that it's very good to just have a visual impact of the main sources of tax revenue that contributed to the fiscus over the past year. As you can see, personal income tax remains the largest source of government revenue, contributing to about 36% of total revenue, which is a marginal decrease in comparison to previous years, which sat at around 39%. Coming in close behind was VAT and corporate income tax. Together, these 3 tax types account for roughly 82% of total revenues collected over the past tax year. South Africa's personal income tax rates still rank amongst the highest in the world, which in our belief leaves little to no room for any improvement or significant changes in the personal income tax rates. In 2022-2023 national budget, this budget took place against the backdrop of South Africa slowly emerging from the throes of the COVID-19 pandemic, as the president announced reduced restrictions, reduced infections, and an uptick in vaccination rates. It is clear that the pandemic has definitely left our country's economy stagnating with low growth and high unemployment. The South African economic recovery has, however, been quicker than expected, with recent positive developments relating to tax collections actually overshooting the medium-term budget projections. And according to National Treasury, output is expected to return to pre-pandemic levels by later this year. This is a year earlier than previously estimated in the previous budget. With these unexpected positive developments, the finance minister definitely had a little breathing room to present this year's tax changes and proposals. With the personal income tax and corporate income tax rates being the forefront and main revenue generator for the fiscus, one of the most critical questions that was on everyone's mind was how on earth would the tax burden be shared between individuals and corporates in this year's budget. Over the last 10 years or so, our government's fiscal policy has, amongst others, focused on containing the budget deficit and slowing the pace of debt accumulation. Most importantly, government has continuously reiterated the notion that our fiscal policy seeks to support structural reforms of the economy, which is consistent with long-run growth, employment creation, and an equitable distribution of income. In this year's budget, however, we see a slight shift from this trend, as the minister restores focus on the core functions of government. We are also on course to diminish key fiscal imbalances and restore the health of public finance. Economists and the wider audience note the current budget to be a well-balanced and definitely responsible budget, despite the post-pandemic economy where red lights still unfortunately continue to flash. Despite a slowdown in the economic recovery, tax revenue did indeed exceed pre-pandemic forecasts. According to Treasury, this was mainly due to the elevated commodity prices, corporate income, and profits being more resilient than anticipated. And then also the domestic VAT collections have grown significantly as household consumption was supported by slightly stronger earnings and low interest rates this year. With tax resiliency being much stronger, the key sentiments of the minister resonated very well with the nation to not increase taxes. South Africans breathed a large sigh of relief when the minister announced that there would be no significant tax hikes. In particular, and to quote the minister, he said, "Now is not the time to increase taxes and put the recovery at risk." Government believes that a continued focus on tax enforcement and rebuilding of Sars can already be seen as improved revenue collections and compliance trends. Sars has continued to focus and in fact intensify its work to counter criminal and illicit activity, resulting in over 5 billion rand being collected through this enforcement activity, with the potential to see better results in the coming future. Another measure implemented is the initiation of a review of all businesses that received payments from national and provincial government over the past 5 years. Such an exercise revealed a number of cases of non-compliance. This has enabled SARS to register businesses that were not previously part of the tax base, thereby contributing to increased revenue collection. It is still clear that government expenditure remains a challenge. In particular, the public sector wage bill still remains a threat, even as the fiscal outlook improves. In addition to the wage bill, demands for additional funding from financially distressed state-owned companies and calls for permanent increases in spending also remain a slight challenge. South Africa remains beset with low growth, while household expenses such as rising inflation and higher fuel costs will set the stage for pressurized public wage talks. We can see a firm line is being maintained by Treasury since the previous budget, by not opting for the easy way out to increase taxes to fund certain government expenditure. Instead, the Finance Minister, Mr. Gordhan, has called for public sector wage restructuring as the government moves to reduce the risk to further improve fiscal outlook. A fresh round of public service wage negotiations are definitely expected to begin in this month. It is clear that our tax policy continues to focus on broadening the tax base, improving the administration, and definitely lowering tax rates in South Africa. Leading up to the budget, many speculated increases in the personal income tax rates, implementation of a wealth tax, or a solidarity tax, and we actually saw none of this come through in this year's budget. This next slide provides a snapshot on what was contained in the budget, and as well as those tax proposals affecting individuals. I'm sure by now everyone is very familiar with these changes, and I just want to take a slight step back and not just read the slides as worded, but just give you a better perspective on the monetary impact these proposals have made to the nation. We see the inflationary increase through a 4.5% adjustment in the personal income tax brackets and rebates. If this was not adjusted, there would have actually been a contribution of additional 13.5 billion rand in extra revenue for the 2022-2023 tax period. An expansion of the employment tax incentives was seen through a 50% increase in the maximum monthly value. There were no changes to the general fuel levy or the road accident fund levy. This was the first time in history, actually. The last time that this ever happened was in 1990, about 30 years ago. And then we see an increase of between 4.5% to 6.5% in excess duty on alcohol and tobacco. The carbon tax levy for 2022 will increase by 1% to 9 cents a litre for petrol and 10 cents a litre for diesel from the 6th of April last year. Lastly, the nation welcomed the news on there being no changes to capital gains inclusion rate, dividends and interest withholding rates, retirement fund tax tables, and tax-free investment contribution limits. To put this tax relief into a more tangible monetary view, the 2022 budget provided 5.2 billion rand in tax relief to support households and the economy. This literally puts back money into the pockets of the taxpayers of South Africa. We then look at the tax proposals affecting corporates, which has been in its own spotlight since the previous budget. Government has noted that changes to the corporate income tax system has the biggest impact on investor behavior, such as it influences jobs, wages, and prices, and consequently can support economic growth by having a positive effect on wage and unemployment, while still promoting additional investment into the country. The corporate income tax rate will be reduced from 28% to 27%, effective for years of assessment ending on or after 31 March 2023. Now, many, including I, have been confused on when actually this effective date for the new corporate income tax rate is actually applicable to businesses. I must admit I had to read the proposal at least 2 or 3 times to wrap my head around it. So just for clarity purposes, the corporate income tax rate will be reduced this year, but all the February financial year ends will be excluded. So simply put, your financial year end has to start on 1 April 2022 if you really want to see some headway in your tax payments. And to just break it down a bit more further, for February year-end companies, the applicable income tax rate for your 2022 and 2023 years of assessment will still be 28%, and then thereafter be reduced to 27% in the 2024 year of assessment. However, if you are a December year-end company, the 2022 year of assessment will be at 28%, and the 2023 assessment will be at 27%. The reduction in corporate income tax rates are expected to coincide with interest limitation provisions in respect of cross-border loans and loans owing to exempt entities, plus the restrictions on the utilization of assessed loss to 80% of taxable income. These base broadening measures are implemented to compensate for the loss of revenue from the decrease in the corporate income tax rates. Following certain reviews last year, including engagements with affected stakeholders and several other members of the industry, several corporate tax incentives will not be renewed when they reach their sunset dates. This proposal is in line with the recommendations of the CATS Commission as well as the Davies Tax Committee. These expiring incentives are noted to not have widened social or economic benefits. Some of these incentives include Section 12s that are noted in the Income Tax Act, and they have expired at the end of last month, and some have expired at the end of last year in December. I would now like to lastly note the other tax proposals impacting individuals. In line with the continued focus that National Treasury has placed on non-residents, when a natural person ceases to be tax resident in South Africa, that taxpayer effectively has 2 assessment periods in the same 12 months of that tax year. The so-called apportionment tax on exit rule will be amended to prevent immigrants from doubling up on the interest exemption and capital gains tax annual exclusion when they cease to be tax resident. The taxation of employer contributions to foreign retirement funds has been quite a contentious area in South Africa for some time now. A review of the exemption of foreign retirement benefits in domestic tax legislation will be conducted as well. Certain double tax agreements, also known as your tax treaties, provide tax relief from South African tax in relation to South African retirement saving vehicles for residents in other countries. South Africa will revisit the applicable DTAs during this year so as to retain the South African taxing rights in respect of the South African retirement funds. As noted earlier, the perceived tax leakage in the initial proposals to tax immigrants on their retirement interests was withdrawn and will be addressed by renegotiating the relevant tax treaties. The budget review confirms that the government will initiate the process of renegotiating these treaties this year. It was further noted in the budget that a discussion document will be published in 2022 on personal income tax regime for remote workers. This is actually a well-received proposal. This is encouraging given that the costs currently incurred by a lot of employees working from home, in respect of which no or limited deductions are currently available to those taxpayers. We expect to see a lot of improvement in this area coming through. Government has also proposed a fundamental restructuring of the retirement system for individuals to allow for greater preservation and partial access to funds through a typically known two-part retirement system. Treasury is proposing a two-part retirement saving system to allow contributions to retirement funds to have early access to a portion of retirement savings for rainy days, and especially in light of the negative effects on households after this pandemic. The system is aimed to help individuals save for retirement, preserve their jobs, and allow for an alternative short-term savings proposal. The proposal is being worked on to allow members access to at least 1/3 of their retirement fund savings, while the 2/3 balance will be needed to preserve for retirement. The tax considerations and consequences of this proposal is still being developed, with the aid of public comment reviews and preparation for public workshops, which we then expect will be followed by legislative amendments coming through. And then lastly, the budget further noted that there will be stronger enforcement against wealthy taxpayers by the implementation of enhanced disclosure of wealth. This proposal was actually welcomed by many, and just a few did not welcome this. In assisting with the detection of non-compliance or fraud through the existence of unexplained wealth, it was proposed that all provisional taxpayers with assets above the 50 million rand mark be required to declare assets and liabilities at their market values in their 2023 tax returns. Up to now, only the cost has been required to be disclosed. The request for market value information provides National Treasury with the view of the market value increases and thus what the potential revenue collections might be. The additional information will also help in determining the levels and structure of wealth holdings as recommended by the Davies Tax Committee. Many have therefore raised the question whether this was the start to gathering information for a possible wealth tax in the near future. Well, with the announcement of huge expected structural increases in expenditure in last week's budget, the funding solution may either be seen through reduced spending, a raise in taxes, or accelerate economic growth. Over the past two budgets, we have seen the minister clamp down on spending as much as possible and propose tax changes to accelerate economic growth, and successfully manage to avoid raising some taxes. We definitely can therefore expect future tax hikes, and we definitely believe that the wealth tax is not completely off the tables just as yet. We expect to see further development in future budgets. So while we wait for the draft tax legislation bill to be prepared and shared for public comment later this year, we recommend that you carefully consider the impact of the tax proposals discussed today for you and for your clients.